Welcome to the Deep Dive. Today, we're really zeroing in on a story that I think perfectly captures the massive shift in commercial real estate.
Mhm.
We're talking about the strategic moves of IWG.
Mhm.
Now, this company isn't just big, it's the global market leader in flexible office space, and yet it seems like it's about to blow up its own structure.
That's right. I mean, our sources all point to IWG as the world's largest provider of this kind of space.
Yeah.
They run something like, what, 300 to 400 centers in over 100 countries? So, brands everyone knows, like Regus and Spaces, they were doing flexible work way before it was cool.
And now that it is cool, they should be thriving.
They are.
Exactly, and that's the paradox we need to unpack today. IWG is riding this huge wave of success. It's fueled by the hybrid work revolution. They're reporting record revenues.
And yet,
And yet management is seriously considering this massive, really complex, maybe two- or three-way corporate split. So our mission is to figure out why. Why would a titan in a booming sector decide to dismantle itself?
the answer really lies in the frustrating reality of public market valuation,
Okay.
or what their CEO, Mark Dixon, he just calls it the value gap. They believe their actual operational success is completely divorced from their stock price. This isn't a strategy born of desperation. It's a move to get rid of what's often called the conglomerate discount.
The conglomerate discount. Okay, that's a key term.
Mm.
For anyone listening, that's basically the idea that when you wrap too many different businesses together,
Right.
real estate, tech, franchising, under one big corporate name, investors get confused. And they sort of punish you by giving you a lower valuation than if you just added up all the parts.
Precisely. The message from IWG is that the market just doesn't know how to categorize them. Are they a real estate company? Are they a high-growth tech platform, a services firm?
And because they're all three,
Because they're all three, the market just defaults to valuing them like the slowest bit, which is always going to be the property-backed real estate.
which brings us to that comparison they always use, the famous one.
Yes.
Yeah.
The ghost of WeWork.
Dixon has pointed right at it. And what's so fascinating is that WeWork, even though it was smaller, and crucially, deeply unprofitable when it went public,
Oh, massively unprofitable.
it achieved a way higher market cap on its flotation than IWG ever did.
But why? I mean, IWG's proven it's profitable, it's huge. WeWork was a giant financial gamble. So why would the market reward WeWork's structure but punish IWG's?
Because WeWork was sold as a pure tech growth story. A software company that just happened to lease some desks. It got a SaaS valuation, a software as a service multiple, which is always much, much higher.
Right.
IWG, on the other hand, is still fighting this perception that it's just a landlord, even though its business has totally changed. So the split is designed to let their tech and franchising arms finally claim those higher growth style multiples.
Okay, that actually makes perfect sense. So the split isn't really about streamlining operations.
Not primarily, no. It's more about strategic marketing to investors. So let's unpack this proposed three-way structure. I want you to try and visualize these as three totally separate companies, each built to appeal to a very different kind of investor.
Okay, so the whole idea is to isolate each function to show its pure measurable value. First, you'd have a dedicated leasing and property management company.
Okay.
This is the part that handles the actual real estate contracts, the long-term deals. It's where the physical assets and, the property risks actually sit.
And the risk profile for that company would be crystal clear. It would appeal to, say, value investors who like tangible assets, predictable income. So what's the second piece?
The second piece is the technology division.
The sexy part.
The sexy part, exactly. A pure-play tech company focused entirely on their digital platforms, their booking systems. And this is crucial because it includes their huge investment in that new workspace booking app, Worka.
And that's the part that's chasing that high-growth, high-multiple valuation, right? They want the market to see Worka as a standalone software company, not just an expense line on a real estate firm's balance sheet.
Absolutely. It's a way to finally unlock the value of all their R&D spending. And then the third proposed entity is the franchising business.
Okay.
And this is where all of IWG's brand equity and their management IP lives. This business is essentially selling their operational playbook.
So if they split off the franchising arm, What is that company actually selling to a franchisee? It's not just the name Regis's or Spaces, is it?
No, no, it's way more valuable than just the name. The franchising business sells the entire package.
A whole stack.
The whole stack, the brand, the standardized procedures, the global sales network, and critically, access to their booking tech and their customer lists. It's a capital light, high margin revenue stream that's based purely on their expertise. And by splitting it out, they highlight this reliable, recurring fee income, which appeals to a whole other segment of investors.
And, this whole restructuring, it really feels like a strategic response to the chaos or maybe the opportunity created by the permanent shift to remote work.
Mm-hmm.
If we connect this to the bigger picture, the entire reason for IWG's record revenues is that we've all adopted hybrid working. And that trend is not slowing down.
No, the sources are clear on this. It is the undisputed engine of this boom. Traditional commercial property is facing, well, an existential crisis. The global economy has just fundamentally changed its relationship with the office building.
And Mark Dixon had that really potent quote about this change. He said that traditional centralized head offices are rapidly becoming either dead or much smaller. I mean, that's a brutal assessment if you're holding long-term commercial leases.
It speaks volumes about what companies are actually doing.
Yeah.
They realized during the pandemic that they just do not need these massive dedicated spaces 100% of the time. So they're shedding long-term liability for on-demand flexibility. And that change is permanent. It's what's fueling IWG's model.
And this demand for flexibility is exactly why you see the rise of these specialized providers for extended stays and corporate travel. You think about companies that provide solutions across Asia-Pacific like MoveAndStay.com.
All right.
They connect business travelers with service departments, serviced offices, for stays that are longer than a few days. They're doing well because the corporate client now demands this kind of flexibility.
That's a great example of the whole ecosystem evolving around this idea. Flexibility is now a crucial corporate tool. Landlords who are sitting on all this underutilized space, they can't find those traditional multi-year tenants anymore, so they're forced to change strategy.
So instead of letting a floor sit vacant, they partner with IWG. Tell us a bit more about that practical impact on the property owners.
Well, for many landlords, it's a matter of survival. They need IWG's brand and their operational expertise to attract this new kind of flexible corporate tenant. The landlord provides the building, the physical asset, and IWG, through its global network and tech, fills the desks. And this leads right into the specifics of IWG's most successful pivot, the capital light model.
Okay, let's talk about that capital light model. It's the key to their reduced risk and their rapid expansion, right?
Mm-hmm.
It means they don't have to tie up huge amounts of their own capital in leases.
Exactly. Historically, IWG's predecessor, Regus, they operated on a very asset-heavy model. They took on the long-term leases themselves, which made them incredibly vulnerable during downturns, like the dot-com bust or the 2008 crisis.
So how does the new capital light contract actually work?
In simple terms, the landlord keeps the main property lease risk. IWG just comes in as the operator.
Okay.
They provide the brand, the design, the tech platform like Worka, their international sales force. And in return, IWG takes a fee or, more often, a share of the operating profits from that location. It's a high-margin management contract.
And the sheer volume of these contracts, that proves the market is buying in. What are the metrics on that?
The growth rate is pretty astonishing. Last year, IWG secured 462 of these capital light deals.
Wow.
And they're on track to blow past that figure this year. It's a really clear indicator of how fast property owners are abandoning that old leasing model.
And this is driving up utilization in the centers themselves. The sources noted that occupancy rates climbed from, 68.2% to 73.5% in just a year.
Yeah, and that 5-point jump is huge when you're talking about a portfolio of 3,400 centers.
It's massive.
And that increased utilization, plus their ability to make some strategic price adjustments, that translates directly to the bottom line. It's why they hit record revenues of £3.1 billion in 2022. That's a 24% increase from 2021. The operational performance is just unequivocally strong.
Okay, so now we get to the part that always confuses people, especially with big public companies. How can a business report record revenues, massive growth, strong occupancy, and still post a statutory loss? We need to unpack that.
Yes, this is critical. The statutory pre-tax loss they reported was $105 million in 2022. And if you just hear the word loss, you assume the company is bleeding cash.
Right.
But that number is heavily influenced by how standard accounting rules treat certain costs.
So what costs are distorting that final number?
Two main things. First, increased finance costs. Global interest rates went up, so servicing their debt got more expensive. That's a real cost, but it's separate from the day-to-day profitability of running the centers.
And the second one?
The second and much more important factor is that huge strategic investment in technology.
The Worka app again.
Specifically, the Worka app. They are spending enormous amounts on R&D for it, and that spending gets recognized immediately as an expense.
So when you build a new tech platform, those development costs hit your profit and loss statement right away, and that creates this big temporary paper loss.
Exactly. But the crucial counterpoint to that is their operating profit.
And that tells a much healthier story.
It really does. When you strip out those one-off, non-operational costs like heavy R&D write-offs and big finance costs, the company actually swung to a really robust operating profit of $147 million.
Okay.
And that is the true health indicator for the core business. It shows the underlying engine is actually generating serious money.
So the underlying health is strong, the outlook is optimistic, they're reporting momentum continuing into this year across revenue, profits, occupancy, pricing,
Yeah.
all of it. So what does this aggressive restructuring tell us about the future of global business?
I think this whole restructuring, it's a definitive strategic answer to market skepticism and just the difficulty of valuing these modern, multifaceted businesses. IWG isn't splitting up because it's failing. It's splitting up because it needs to scream at the market that its technology and its franchising IP are way more valuable than anyone is giving them credit for. It's an exercise in demanding a higher valuation, which, raises a pretty important question.
If a profitable global leader like IWG, a company that's absolutely thriving because of this shift to flexible work, feels it has to split itself into these neat little boxes, one for assets, one for high-growth tech, one for franchise revenue, just to close that gap between its success and its stock price, what does that suggest about the future specialization required for any successful global business that's catering to the hybrid workforce? We might be entering an era where companies aren't rewarded for massive scale, but for absolute clarity and simplicity in how they're structured. Maybe that clarity is the only currency that's going to matter to investors from now on.